TheoTrade. This is Don Kaufman. October 2nd, 2021, doing the TheoTrade weekend update here on a Saturday morning. Once again, some fairly tumultuous volatility hitting the overall marketplace throughout the course of this past week. But hey, I'm not telling you anything you were not aware of. What we're going to focus, though, on this weekend's update is really that markets have hit an absolutely critical volatility inflection point. We're going to cover that and much more here on this weekend's update. I'm also going to discuss in quite some detail a little bit how the dynamics of professional trade work in the midst of some of this volatility. So let's get to work. We're going to cover that, a lot more, some trade ideas, a couple of sectors that we're going to look at here. Let's get to work here. Again, risk has really enveloped the marketplace. Now, if you took a look at, Friday's trades, the S&Ps, okay, they got their groove back. They, bounced by the tune of about 1.2% here on Friday. Nevertheless, the NASDAQ lagged considerably. And there's a bit of a tell in there, which I'll come to a little bit later. One of the things that I have tendency in the midst of volatility to focus on a bit less is some of the day-to-day price action. I know that everybody's looking at the price action and they're like, it's up, it's down, it's so down. I mean, listen, we cracked outside the edge of the expected move in the SPX. It got downright ugly. I mean, net, the week started around 44, let's call it 50. We touched all the way down to 4,300. So in effect, you got a 150 point plus move to the downside inside of the SPX. Again, the marketplace is kind of rocking and it gets a little bit of a bid back under it. But I need to push aside, again, some of that kind of day-to-day price action, because what people get caught up in is, oh yeah, there's the bounce in the marketplace and they're going to buy the dip. That's just a bit of a recoil at this point from some hedging activity. But again, push that aside for just a moment. We want to look at a lot of factors because I start, the conversation not with a recap of last week's trade. Push it aside right now. Again, day-to-day price action isn't going to matter that much. You got to look that risk has kind of enveloped the markets, but we're still at this really serious volatility inflection point. One of the first things that I want to point out, a little bit off the beaten path, when we're talking about volatility, not too often somebody brings up the dollar, but I think you have to have a little respect for the move that did occur in the dollar throughout the course of this week. The dollar broke out. The dollar actually smashed through, what have been some, highs that have held for quite some time. And I got to tell you, a 9-month chart in the dollar just doesn't do it for you. You got to open up at least 3 years and you're like, whoa, all right, this is a pretty serious move to the upside in the dollar. So why do I look at the dollar as, a risk tool of any magnitude? And I really do. I look at the dollar as almost in effect, like the VIX at this point. Because if you're scared, really scared in the world right now, where are you going to put your capital? And I always want people to think about that. People go, oh, I go to cash, I go to this. Listen, professional trade can't go to cash. There is no cash. You either got to go into the bond market. And people go, what do you mean there isn't cash? Listen, if you're over in Europe right now, you have a few $1 billion under management, you can't go to cash. They will charge you. Literally, it's NIRP, negative interest rate policy. Most of the banks will actually charge you to go into cash. There's no cash alternative. So in effect, where are they going to? Just to mitigate exposure, a lot of them are moving to the dollar. What are you going to do? Leave your capital in the euro? Maybe go out there, get crazy, buy some yuan, maybe buy some Russian ruble. Where are you going to go in the midst of real volatility? And the answer is to the dollar. And because the dollar ripped to the upside, it did put the, smack down a couple of commodity products early in the week. Although even gold bounced a bit. But if you took a look at silver throughout the course of this week, things got downright wicked in a few of the metals. And that's, again, predominantly because of some of the dollar explosion. So right off the bat, this is a trade that's absolutely unequivocally worth noting and watching throughout the course of this next week. What you want to watch this next week, it's not so much about price action in the S&Ps, because I'll tell you all day long, price action, listen, it's a bounce on Friday, but it's only a 1% bounce. I mean, we just had, again, fairly significant sell-off, all right? The last few weeks, it brought some serious volatility. And if trade continues to reach for the dollar, meaning if they're buying the dollar in this next week of trade, you got to expect things are going to get downright hostile in the S&Ps, and that's the kind of action. So moving with that, let's cruise over to the bond market. The bond market, which is probably what actually caused most of this volatility. And it's exactly what we kind of, discussed in the last few weeks of trade, that the next major move in the markets, and we've been talking about this for the last month, but the next major move in the markets was going to be largely predicated on interest rates on the bonds. So the bonds sold off significantly over the last 2 weeks, bounced a little bit towards the end of the week, and of course things kind of mellowed out. Obviously, watching this trade is going to be critical, but even more so, if you take a look at the TNX, that's the 10-year interest rate, this 1.5 is just a critical inflection point. Anything north of that 1.5%, but the marketplace will kind of get normal and used to it. Like, it'll normalize. All right, 1.5, we can handle 1.5. Yeah, until we jump to like 1.6. So at this point, you're kind of put on notice. Interest rates are going to matter, but bonds themselves in just the last, few trading sessions have become very much like a double-edged sword. And that basically means this, right? And I want you to look at the continuation of bonds. If bonds get wicked again and start to sell off, they sell off, the interest rate obviously goes higher. If the interest rate goes higher, they're going to come after big tech and sell big tech. It's just the bottom line. So bonds selling off is going to destabilize the S&Ps. But at the exact same time, I think you can make a pretty good argument that if the world starts to run and starts to buy bonds and bonds take off to the upside, well, that's going to take the percentage interest rates substantially lower. Now, I have a tough time believing that one, but if it does happen, then they're going to come for the financials. So why? Because it's taking interest rates lower. Bonds right now, if they don't start channeling back and forth in a very tight range, markets are in trouble in either direction. Again, I would say that at this point in time, if bonds are to rally substantially, it's probably, because the S&Ps are selling off massively. As I said a moment ago, there's just not a lot of places to put money right now. Where are you going to go? Where are you going to run to? Where are you going to hide right now? And what's the answer in here? Somebody, of course, is going to email me and say, it's Bitcoin! And you know what? Hey, maybe so, because Bitcoin did explode back onto the scene. But that's exactly the point that I'm trying to make. There's just not a lot of places right now to play, hide Mr. Capital. So bonds have become really a double-edged sword. Big action in bonds looks fairly dire for the S&Ps in either direction. The next thing I want to cover is, where's the implied volatility spike? One of the things that really bothered me throughout the course of the week, I can see where the VIX kind of came down yesterday. But what bothered me is you had some pretty serious selling going on and throughout the course of the week. And I think we can, of course, point to, September 28th. You can point to some of the sell-side activity on the 30th. But there's some fairly serious sell-side activity going on where the S&Ps at one point, and again, let's just put this in context. Right here is a move from 44.40 literally to 43.40. All right, in one day, the SPUs dropped by 100 handles, 100 points in the SPUs. Okay, so that's on 9/28 in the exact same day. In the exact same day, did volatility pick up? Yeah, sure it did, but it didn't even hit 25 in the VIX. Okay, so why? Because we already saw the risk hit the fan on September 20th. So one of the things you got to kind of remember here is risk. When I say hit the fan, I mean literally we saw that type of 100-point drop just a few weeks ago. The markets actually got some short-term financial memory. And where's the implied volatility spike? Well, here's the scary thing. At this point in time, again, when we say we've hit like a serious inflection point in volatility, all right, if you want to see some real volatility, you're going to have to see something just downright hideous, downright scary. And that's exactly what volatility is kind of professing at this point. You read into the volatility, whether it's the VIX, you want to go look over at the volatility futures, okay? Volatility futures, they never went into backwardation Okay, this past week, they never went into backwardation. That is, if you looked at the short-term vol futures, and I've talked so extensively about this, but if you looked at short-term volatility futures versus longer-term, right? So this is an 18-day OCC versus a 46-day NOV. They're still in a pretty wicked contango. I mean, these are roughly, let's just put it at 21.50. These are trading almost like 23. I mean, listen, you got $1.50 between these two. And, you can actually graph that out a little bit. But rather than spend time looking at a volatility depth chart, one of the things you really want to just recognize about this is markets are selling off and volatility isn't raging, which in effect means no one's really feeling the fear right now. And if you want to see capitulation in a marketplace and you want to see if you're a bull right now in this market, like, look, the market, it rallied big. Yeah, but you can't feel warm and fuzzy in this price action. You can't feel warm and fuzzy with a 1% move to the upside, where the NASDAQ was lackluster. It was only up 0.6%, like the NASDAQ literally had half the move of the S&Ps to the upside. And we never saw volatility futures flip over. We never saw the extreme. We never saw, traders out there puking their guts out. That's exactly what I'm saying with where's the implied volatility spike. On top of it, and to make it even more complex, right, the SKEW softened substantially. By the way, if you ever look up SKEW, you do have to actually change the chart over here from like a candle. You go over to the line chart. Look at SKEW. It collapsed. So one of two things with SKEW collapsing. Okay, either traders are out there selling puts like there's no tomorrow, or they're out there like, buying calls, but the SKEW has flattened out. And I would suggest that there's a lot of premium sellers on the professional side because it almost looks like volatility is suppressed. What I'm basically saying is if you look at the VIX, you look at the volatility futures, you look at the SKEW. In effect, what I'm saying is that it's very likely that trade is pouring into the SPX options, and they actually are selling premium in here, and they're selling premium with a pretty steady hand. So I went in here and looked at the option statistics. If you look at the option statistics, though, everything looks pretty normal. Like the number of calls traded versus the number of puts, it's spot on. So then I cruised over to the spiders, right? And I looked up some of the option stats in the spiders. Listen, everything is spot on. It's not like any crazy, big offers for sale, but it definitely feels to where volatility is almost suppressed, which kind of tells me that, again, professional trade is coming in there and they're selling a ton of boatloads of naked options, probably puts inside of the SPX, and that's where the SKEW is kind of flattening out a little bit down to the 135 level, which is okay, but that can also lead to substantial future risk. And that's exactly why we're going to talk about the dynamics of professional trade in just a moment here. One of the other aspects that really, really resonates with me, and as I was saying, like I think a lot of professional trade is selling, and I know that to be I know that to be true, of course, by looking at nothing more than SKEW. If you look at the SKEW here, like here's October 4th expiration, October 6th expiration. I just want to highlight these for a second. So that's just a Monday expiration. You got a Wednesday expiration, a Friday expiration. Take a look how low the implied volatilities are. Like this is just, it's perplexingly low implied volatility until you realize that there's a lot of trading firms that are in the very near-term options, very near-term options. They will sell huge amounts of these options and sell them naked. And I know a lot of people like, oh, that's a good idea. It's not a good idea. Not unless you have the ability to hedge on the fly. Like these professional firms, okay, are out there and they're selling boatloads of calls and boatloads of puts. And if the market starts to slip against them, they have an auto hedging device that's actually mitigating exposure in real time inside of the S&Ps. And they can do it 24/5. So they don't have the risk that you do. Anyway, the volatility in these short duration options is just being crushed. What I'm saying by this is front month premium is low relative to movement. When you look at this, like even to next week, the expected move for next week is actually going to be $89. But the point I'm trying to make, $89 is the expected move for the entire week. Are you kidding me? We moved $100 in one day last week. We've had ranges of $89 almost every single day inside of the S&Ps. I mean, we had a 50-point up move, but we had sell-side activity before that. I mean, look at the range from low to high. Again, it's almost a 100-point move just yesterday. I mean, this is just on Friday's trade. So when you start looking at the expected moves in here, okay, I'm just going to throw it out there, and, I'm kind of, beating around the bush with this one. You're nuts if you're selling short duration premium. Just downright nuts. All right. It is way tight, man. There's no way I would sell some of that short-term premium. You got to look towards the back month expirations. Back month expirations all the way out here. Look at this 22 vol. Like, even these, okay, they're not stellar, but they're a lot better than selling some of that front month premium. Even a 12 vol for like Monday's trade, only a $39 expected move after we had almost a 100-point move is chaotic in my mind. So the dynamics of professional trade in the midst of volatility, one of the aspects that I really want to kind of resonate with you in here is when you think about professional trade, and people think about professional trade in a lot of different ways, but what I'm talking about with professional trade, proprietary trading firms, right, market making firms, they're all, roughly speaking, okay, they try to maintain very close to flat deltas. So in effect, what you get, and why do they maintain, I guess, flat deltas? Flat deltas basically means they're not trying to incur any directional risk in the S&Ps. They're not trying to incur any directional risk in Apple or any of the other products. Like if you look at a market making firm like Citadel, they are not taking directional risk. A lot of it actually has to do with legislation. It's part of the Dodd-Frank, the Volcker rule, if you're interested in looking into it. So the proprietary trading firms are not taking a lot of directional risk. What they in effect do is they hedge with the dynamic of the marketplace. So if you're a market making firm, and I'll just kind of highlight this and do it kind of briefly here, but if you're a market making firm, your portfolio would look something along the lines of this being representative of the marketplace. So trading firms are out there and they have positions on everywhere. Let's just assume that this is their position inside of the SPY. They've bought and sold strikes all over the place. What they're trying to do is maintain, for the most part, very close to delta neutrality, right? It doesn't necessarily mean delta zero, but what happens a lot of the time is retail trade buys options, which actually forces a lot of the professional trade, to be premium sellers. So if they're selling, what happens is they move inversely to the dynamic of the marketplace. If the marketplace starts to sell off, usually the firms, have sold puts. And if you sell puts, think about this. If you've actually sell puts and the market starts to sell off, your delta very rapidly becomes positive. So how do you actually negate positive delta? By adding negative delta. Where do you find negative delta? They have a server that just drives trade directly into the S&Ps. They sell S&P futures. So the dynamic of trade in a marketplace that starts to get volatile, the trade is literally driven, second by second, up and down, all through the dynamics of server-driven hedging activity. So when we start to sell off, let's say we start to sell off, all the trading firms jump on board and start to sell into the selling, all right? And at that point, once the trade goes fully intrinsic, we can actually get bounces in the marketplace. When you see these wild sell-offs in the market and all of a sudden we rip and we bounce, everybody's high-fiving one another. Yeah, that's because their delta hedge went to full intrinsic value, like the delta went to 1. And that gets really complicated, and that's something I could explain a bit more while live on TheoTrade. But I wanted to give you guys a feel for, again, the dynamics of trade and volatility. No one on the professional side cares, about, you, or it's basically, every man, woman, and child for themselves. It's about hedging. That's all they care about. They want to churn as much trades through their portfolio as they can. If it's a market-making firm, they just, capture bid-offer spread. And when it gets volatile, they make a ton of money because the bid-offer spreads widen out. So they widen out and they just hedge. Everything comes in and gets hedged, and it gets hedged in real time. People always ask, how long does it take to do those hedges? We're actually talking right now, in millionths of a second. So there's even firms that quote in nanoseconds now, billionths of a second. Nevertheless, this is representative of pure hedging, and that's something that you have to be concerned about moving forward, because if volatility does start to spike, all right, that hedge, the dynamics of the hedge can turn just hideously negative. The higher the volatility, the more wild some of the hedging activity gets and can actually drive markets to extremes. All right, push it all aside for a second. The one aspect that I really want to have resonate with you on this weekend's update here, there's no rhyme, no reason. There might be another bid coming back in on Monday, some more sell-side activity. You got to stop trying to handicap, all right, day to day and pulse to pulse kind of moves. You got to start thinking a little bit like a week out, 2 weeks out, 3 weeks out. And I'm going to tell you right now, it does appear that we are going to be in the throes of some very significant volatility for an extended period of time over here. Part of that is largely predicated what I'm going to do right now, some sector analysis, the monsters of tech. The monsters of tech, these are all your big tech stocks. For those of you that do not tune in, the monsters of tech is a conglomerate symbol that I built. It's Apple, it's Amazon, it's Facebook, it's Google, it's Microsoft, all compiled into one loving symbol over here. They're in trouble. They bounced a little bit, but I mean, they're up to the tune of 1.4%, which is all right. Most of that bounce, though, actually came specifically out of Microsoft and Google, which are two of the most pivotal stocks right now on the screen. But one thing I want to put in perspective, if you look at something like Google, it's still up. And again, this is critical. Google's up 58% on a year-to-date basis. Okay, that should still bother you. You look at something like NVIDIA. Okay, quite ironic because, listen, you look at Google, and Google is actually up 70% year-to-date basis. You look at NVIDIA. NVIDIA was also up 75%. Now NVIDIA is only up 58%. But a little, perspective over there, they're still up like 58%. You look at something like Facebook. Facebook was actually up over 40%. Now it's only up 27%. Everybody in big tech is in full-blown corrective territory right now. Microsoft is actually still like an area of hope. It is only down about 7-8% from some of the recent highs over here. Nevertheless, there's no question that tech is in trouble. You look at stuff like Tesla. I think Tesla's almost taken out of the equation right now. It's only up 6% on a year-to-date basis. Same is true of like Amazon. Amazon's basically flat on the year. Apple, okay, Apple's up 10% on the year, but again, it's actually weighing on markets, which is kind of ironic. Big tech right now, there's no question it's in trouble. But again, you can't focus on the day-to-day, whims of the marketplace. It's going to be interest rates that are going to start to really shift, again, a lot of what is going on in big tech. And right now, looks pretty dire. It looks dire simply because everybody's talking about inflation. If you're talking about inflation, well, interest rates may continue to go a little bit higher. Interest rates go higher, they're going to come for tech. And that's one of the, again, it's one of the reasons I was telling you that, those bonds are a little bit of a double-edged sword. Onward and upward over here. Financials, they're just downright volatile. Here's one interesting aspect about financials. If you looked at a lot of tech throughout the course of the week, and you looked at auto expected moves, tech got just walloped. Financials actually finished the week massively unchanged, which is we had a couple profitable trades in here. You can see I'm still working some orders, but a few profitable trades inside of the financials. But one of the key takeaways, finished massively unchanged. Whereas if you look at the QQQ is 2 deviations out. So right now what we are seeing is, again, tech is absolutely breaking down, but I caution you on that particular front. Financials, they're almost completely unscathed. If you're looking right now for a short position in the marketplace, I don't care whether you think the bonds and interest rates are going to go higher or lower. Okay, if markets are going lower at this point, they're going to take out financials. Financials are going to be carrying that bag of risk. Think about that moving forward. On top of it, energy on the week. Unbelievable move to the upside. I would look for a wicked pullback coming in here. Why? Well, this is kind of a quintessential setup. We actually crested through the expected move last week. We smashed the expected move this week. Look for energy to possibly have an early bid in the week and then followed by some sell-side activity. I may actually look for this is a nice bounce in here, but I may look for a fade trade, probably using in and out spread in the near term inside of the energy sector. And again, push aside what you might think about energy prices. This is actually the energy sector, and these stocks are very likely to get pulled down with the remainder of the marketplace. I also want to, shift a little bit of our focus, and that focus, rightfully so, should shift to some of the retail stocks. And this was missed in the midst of a lot of volatility here. I think a lot of people missed the idea of take a look at stuff like Costco. Even in a wild up day inside of the marketplace, which was Friday, right? Costco, okay, took a hit. On a percentage move in the week, took a fairly substantial hit, but auto expected moves present the case even more effectively. Costco off of some recent highs, okay, 2 deviations outside, right? Take a look at Walmart. I mean, Walmart has just an absolutely massive move to the downside on Friday once again. Take a look at Target. All of this, okay, is in the wake of what we saw with Bed Bath & Beyond. And if you missed the Bed Bath & Beyond, okay, Bed Bath & Beyond got absolutely decimated in earnings, right? There's real concern right now around some retail trade. Now, the retail trade, the only reason I'm bringing it to your attention is specifically to tell you that that retail trade, that could actually really start to proliferate into the hearts and minds of pretty much everybody. That's much more of a mindset. If retail isn't doing good, nobody's doing well. We'll actually look for that to materialize. That's not a trade I necessarily want to take here in the near term, but look for it to kind of materialize throughout the course of this week. Again, when it comes to underlyings like Target, like you wouldn't think this is a pivotal underlying, okay? Something I brought up last week, of course, was Home Depot. Okay, watch Home Depot this next week. We told you that this is very likely, if there's going to be more sell-side activity in the Dow last week, that this one's going to be involved. Of course it's involved, but there should be some serious follow-through because if, again, some of the big box retailers are taking a hit, you would expect Home Depot on a percentage basis to probably accelerate beyond that. All right, last but definitely not least, expected move in the week. So throughout the course of the week, we smashed the expected move. We smashed the expected move early on, pretty much in the week. On Tuesday, you know, we were down big. We stayed outside the edge of the expected move. We finished the week outside of the expected move. Okay, this coming week of trade, and this is important. This coming week of trade has an $89 expected move. Here's just the bottom line. If we close and start getting outside the expected move and start closing days outside the expected move, it means real definitive turmoil is coming to the marketplace. Why? It's actually a marketplace that's kind of cracking apart, if you will, with like inefficiency. So markets are incredibly efficient until they're not. And this is something, again, I'll explain throughout the course of this week here on TheoTrade. Efficient markets versus a little bit of inefficiency starting to break through. This is a major breach of expected move. Any continued breach of expected move, all of a sudden things get downright wild. And that's exactly why I'm saying that markets, they have hit a really serious volatility inflection point. We could be at a breaking point inside of the S&Ps for a considerable period of time, okay? And as I said, there's no easy way to handicap day to day. Look at the signs that we've pointed out throughout the course of this weekend's update. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.